What if I told you that even if you pack your bags, sell your house, and leave California tomorrow, the state could still come after your money? According to recent enforcement trends, California collects billions of dollars every year through aggressive residency audits, and thousands of former residents are still fighting tax bills long after they moved. Now here's the shocking part. March 1st is just 3 days away, and new enforcement rules are tightening even further. Most people think once they cross the state line, they're free. But what if your income, your investments, or even your remote job keeps you legally connected? What if California still considers you a resident, even when you don't? That's the question many families are asking right now. In this video, we're breaking down 10 powerful law changes that could affect you no matter where you move. Some are already active. Others are expanding quietly. And if you don't understand them now, you could be paying for it later. Number 1. Residency Audit Expansion. First, let's talk about the most powerful tool California uses to keep people on the tax hook: residency audits. Many people believe that once they rent a place in another state, change their driver's license, and forward their mail, they're officially out. But California doesn't just look at where you sleep. They look at where your life is centered. Where is your doctor? Where do your kids go to school? Where are your primary bank accounts? Where do you spend most holidays? These details matter more than people realize. Under expanded enforcement practices, the state's tax authority has become far more aggressive in reviewing what's called domicile intent. That means they examine not just your location, but your intention to permanently leave. Auditors may review travel records, cell phone data patterns, property ownership, business ties, and even social connections. If they believe you maintain strong ties to California, they can classify you as a resident, and that means full state income tax liability. Here's what makes this serious. The burden of proof is on you. If California challenges your residency, you must provide clear documentation showing you truly moved. Without strong evidence, lease agreements, utility bills, travel logs, employment records, you could face back taxes, penalties, and interest. This is why understanding residency audit expansion is critical before March 1st. If you're planning to move, or already moved, comment "moving" below so we know your situation. We put serious research and effort into breaking these laws down for you, so please support the channel. Subscribe now, it's just one click but it helps us massively. Number 2. Exit tax threat. Now let's discuss something that has made high-income earners extremely nervous: the growing conversation around a potential exit tax. While not every proposal has passed into permanent law, California lawmakers have openly explored ways to tax certain wealthy individuals even after they leave the state. And the idea behind it is simple but powerful. If you built your wealth in California, the state believes it deserves a share, even after you relocate. Here's how it could affect you. Some proposals have focused on individuals with significant net worth, especially those with large stock portfolios, business ownership stakes, or major capital gains. The concern isn't just about current income. It's about future gains tied to assets accumulated while living in California. In certain discussions, there were look-back periods of several years, meaning income realized after moving could still be partially attributed to your time in the state. Why does this matter? Because timing becomes everything. Selling a business, exercising stock options, or cashing out investments right after relocating could trigger complicated tax exposure if laws tighten or enforcement expands. The key takeaway is this: before you move, or before you sell major assets, understand the structure of your wealth. The wrong move at the wrong time could cost far more than you expect. Thinking about relocating for tax reasons? Comment "exit" below so we can see how many of you are considering it. And if this breakdown is helping you, hit subscribe right now. It's one simple click, but it keeps this research coming. Number 3. Remote income trap. Now here's where things get even more complicated, especially if you work from home. Many people assume that once they physically move out of California, their tax obligation disappears. But if you're still earning income connected to California, you may still be pulled into what's called a tax nexus situation. Let's break this down simply. If you work remotely for a California-based company, own a business registered in California, or generate income tied to clients in the state, California may argue that your income has a source connection to the state. That means even if you live in Texas, Nevada, or Florida, certain income streams could still be considered taxable by California. And this is where people get caught off guard. Many remote workers don't update their payroll sourcing. Some businesses forget to formally change their entity registration. Others continue using a California address for contracts or banking. These small details create a paper trail that auditors can follow. The practical move. Review your employment agreement. Confirm where your income is legally sourced. Update business registrations. Change mailing addresses. Make sure your payroll department reflects your new state properly. A simple oversight could turn into years of unexpected tax bills. The remote income trap is one of the most misunderstood risks people face when leaving the state. Are you working remotely for a California company right now? Comment "remote" below. And if this is eye-opening, take 1 second and subscribe. Your support keeps these deep dives coming. Number 4. Capital Gains Lookback. Now let's talk about something that surprises even seasoned investors: the capital gains lookback risk. Many people assume that if they move out of California and then sell a business, stock portfolio, or property, the profits are only taxed in their new state. But it's not always that simple. California carefully examines when and where an asset was built. If your company grew while you were a California resident, or your stock options vested during your time in the state, the tax authority may argue that part, or sometimes all, of that gain is tied to California. In certain cases, authorities analyze what's called income sourcing, and even apply multi-year reviews to determine whether the appreciation happened while you were still domiciled there. This becomes critical if you're planning a major liquidity event. Selling your startup 3 months after moving? Exercising long-held stock options right after relocating? Timing matters more than people realize. A move that isn't fully documented, or a sale that happens too soon, can trigger audit scrutiny. The smart move is proactive planning. Speak with a qualified tax professional before selling major assets. Review vesting schedules. Understand sourcing rules. Sometimes waiting, even a few extra months, can make a dramatic difference in your exposure. The capital gains lookback isn't widely discussed, but it's one of the costliest mistakes people make. Planning to sell a business or investment soon? Comment "selling" below so we know. And if you value this level of breakdown, please subscribe now. It's one click for you, but it fuels everything we do here. Number 5. Trust residency rules. Now let's move into an area most people never think about, until it's too late: trust residency rules. Many families set up trusts for estate planning, asset protection, or inheritance planning. But what most don't realize is that California doesn't just look at where you live, it can also look at where your trust lives. Here's how it works in simple terms. A trust can be considered a California resident trust if the trustee, the beneficiary, or even certain administrative decisions are tied to California. That means even if you personally move to another state, your trust could still be classified as connected to California, and that could mean continued state taxation on trust income. This becomes even more serious for high-net-worth families. Investment income inside a trust, capital gains distributions, and retained earnings can all fall under California tax rules if residency triggers apply. And many people never update trustee appointments or trust administration locations after moving. That oversight can quietly keep them tied to the state financially. The practical step. Review your trust documents immediately if you're relocating. Consider where trustees reside. Evaluate where decisions are made. Make sure administrative records reflect your new state properly. The trust residency rules can quietly override your move if you don't plan carefully. Do you have a family trust set up? Comment "trust" below. And if this information is helping protect your future, please subscribe today. Your support keeps this channel alive. Number 6. Digital income surveillance. Now let's talk about the modern income stream many people believe is invisible: online money. Whether you run an e-commerce store, earn from YouTube, trade crypto, consult online, or sell digital services, California is expanding how it tracks digital income. And this is where many remote entrepreneurs underestimate the risk. The state increasingly relies on 1099 reporting systems, payment processor data, and interstate information sharing to identify where income is generated and who it's connected to. If your LLC is still registered in California, if your business bank account remains there, or if your digital contracts reference a California address, that can create a taxable footprint, even if you're physically living somewhere else. Many creators assume that because their customers are global, their tax exposure disappears when they move. But California may argue that if the business infrastructure was built there, or if operations are still legally tied to the state, income remains taxable. And audits in the digital economy are becoming more sophisticated every year. The smart move: update your LLC registration if necessary. Change your registered agent. Move business banking. Review your digital contracts. Clean transitions matter. A sloppy move can trigger years of unexpected tax notices. The digital income surveillance era means online income is no longer off the radar. Are you earning money online right now? Comment online below. And if this breakdown is protecting you, please subscribe. One click from you keeps this research coming. Number 7. Rental property tax. Now let's talk about something thousands of former Californians overlook: rental property income. Many people move out of state but keep their California home as a rental. On the surface, that seems smart. You keep the asset, collect income, and build long-term equity. But here's the reality: owning income-producing property in California keeps you financially tied to the state. Even if you relocate to Nevada, Texas, or Florida, rental income generated from property located in California is still considered California-sourced income. That means you are required to file a California non-resident tax return reporting that income. And if you fail to do so properly, penalties and interest can add up quickly. It gets more complex if you later decide to sell the property. California may require withholding on the sale, and capital gains from California real estate remain taxable by the state, regardless of where you live at the time of sale. The practical step: if you keep California property, understand that your tax filing obligation likely continues. Work with a tax professional who understands multi-state filings. Keep clean rental records. Plan ahead for potential sale timing. The rental property tax connection doesn't disappear just because you moved. Still own property in California? Comment property below so we know. And if this information is helping you stay ahead, take 1 second to subscribe. Your support truly makes these deep dives possible. Number 8. LLC registration crackdown. Now let's talk about something business owners often ignore during a move: their LLC registration status. You may physically leave California, but if your business entity is still registered there, the state may still consider you connected for tax purposes. Here's what many people miss: California charges an annual minimum franchise tax for LLCs registered in the state, even if the business earns little or no income. If you relocate but never formally dissolve, withdraw, or convert your entity, those obligations don't automatically stop. The state doesn't assume you left. On paper, your business is still active, and that means ongoing filing requirements. It becomes even more serious if your LLC continues generating revenue. California can argue that the company is doing business in the state if management decisions, contracts, or operational control are still tied to California records. And penalties for missed filings can compound year after year. The practical move: if you're leaving, formally close or transfer your entity. File the proper termination paperwork. Update your registered agent. Notify tax authorities. Don't rely on silence, because silence doesn't cancel liability. The LLC registration crackdown catches many entrepreneurs off guard simply because they assumed moving was enough. Do you own an LLC in California right now? Comment LLC below. And if this warning just saved you future headaches, please subscribe today. 1 click from you keeps this channel growing. Number 9. 183-day rule scrutiny. Now let's talk about one of the most misunderstood rules: the 183-day presence test. Many people believe that if they spend fewer than 183 days in California, they automatically avoid residency. But here's the truth: California does not rely on a simple day count alone. Instead, auditors examine the total pattern of your life. The 183-day figure is often used as a reference point, but California focuses heavily on where your closest connections remain. If you maintain a home in California, keep your driver's license there, have family living there, or spend significant time back and forth, that weakens your case. Even frequent short trips can add up. Auditors may review flight records, toll data, credit card transactions, and even cell phone location history to reconstruct your presence. Here's where people make mistakes. They move but continue spending extended periods back in California for business, family, or lifestyle reasons. That blurred line gives the state room to argue that you never truly severed ties. The practical step: Track your travel carefully. Keep a clear day log. Shift important documents, voter registration, medical providers, vehicle registration, to your new state. The cleaner the break, the stronger your protection. The 183-day rule scrutiny is not about one number. It's about the full story of your life. Are you splitting time between states right now? Comment "split" below. And if this clarity is helping you plan smarter, please subscribe. Your support keeps these critical updates coming. Number 10. Financial data sharing. Finally, let's talk about the quiet shift happening behind the scenes: expanded financial data sharing. Over the past several years, state tax authorities have increased cooperation with federal agencies and other states. That means information moves faster than ever before. Banking records, reported income, business filings, and multi-state data exchanges are far more streamlined today than they were a decade ago. Why does this matter to you? Because inconsistencies are easier to detect. If you claim to be a resident of another state but still maintain significant financial activity tied to California, such as primary banking, investment management, or registered addresses, that data can raise red flags. Automated systems now compare filings, cross-reference addresses, and flag discrepancies for review. Many people assume that once they change their mailing address, everything updates automatically. It doesn't. Payroll records, brokerage accounts, retirement custodians, insurance policies, all need to reflect your new state accurately and consistently. One outdated account can undermine your residency claim during an audit. The practical move: conduct a full financial audit of your own records before the state ever does. Update every account. Align documentation. Eliminate conflicting data points. The era of limited oversight is gone. Financial data sharing expansion makes precision more important than ever. Are you confident all your financial records match your new state? Comment "ready" below. And if this series helped you see the bigger picture, please subscribe today. One click from you keeps this research alive and growing. As we approach March 1st, the real message here isn't panic, it's preparation. The biggest mistake people make is assuming that moving out of California automatically ends their financial relationship with the state. But as you've seen today, residency audits, exit tax discussions, remote income rules, capital gain sourcing, trust classifications, rental income obligations, LLC registrations, day count scrutiny, and financial data sharing all paint a much bigger picture. California doesn't just look at where you live, it looks at where your economic life is connected. The truth is, most tax problems don't happen because someone tried to break the rules. They happen because people didn't fully understand them. A missed document. An LLC left open. A property still generating income. A payroll record not updated. Small oversights can turn into large penalties when enforcement expands. And with data sharing becoming more advanced and audits becoming more detailed, precision matters more than ever. But here's the empowering part. When you understand the rules, you can plan properly. Clean transitions, documented moves, structured asset sales, updated registrations, these steps protect you. Moving can still make financial sense. Relocating can still create opportunity. You just have to do it strategically, not emotionally. So as the deadline approaches, ask yourself one simple question. Have you truly severed your California ties, or just changed your address? Awareness is your protection. Planning is your shield. And information is your advantage. Stay informed. Stay prepared. And most importantly, stay ahead.